Every week you hear headlines like, inflation is rising, the Federal Reserve hikes rates, the stock market crashes or rallies. But what does this actually mean for your money, savings, job, and future? Today, I will break down U.S. economic news in the simplest way possible, step by step. No complicated terms. No confusing charts. By the end of this video, you will understand what CPI really means, what the Federal Reserve actually does, why interest rates control the economy, and how the stock market reacts to all of it. If you want to make smarter financial decisions, this video is for you. Let's begin. What is CPI? CPI stands for Consumer Price Index. It is simply a way to measure how prices change over time. Think of CPI as a price report card for everyday life. The government checks the prices of things people use every day. Food at the grocery store, gas for your car, rent for your home, electricity, transportation, and healthcare. They write down today's prices. Then they compare those prices with last year's prices. If today's prices are higher than last year, that is called inflation. This means your money is losing value because you need more money to buy the same things. If today's prices are lower than last year, that is called deflation. This means your money is gaining value because things are becoming cheaper. Here's the simple truth. CPI tells us if life is getting more expensive or more affordable. When CPI goes up, people feel pressure. When CPI goes down, people feel relief. So remember this. CPI is not just a number on the news. It is a mirror of your daily spending. Why CPI matters to you? CPI matters because it directly affects your daily life and your money. When CPI rises, prices go up everywhere. Groceries become more expensive at the store. Rent increases each year. Transportation costs more for gas, buses, and rides. Even your electricity and basic needs get more expensive. But here's the real problem. Your income often stays the same. So every time CPI goes up, your money buys less than before. You may earn the same amount, but your lifestyle slowly becomes more expensive. This is why inflation is dangerous. It quietly eats away your purchasing power. It doesn't take your money from your wallet, it takes value from your money. That's why people watch CPI so closely, because CPI tells us if life is getting harder or easier to afford. How to read CPI news. Easy method. Whenever you see CPI news on TV or social media, don't get overwhelmed by the numbers. You only need to ask 3 simple questions. First question, is inflation rising or falling? If inflation is rising, life is getting more expensive. If inflation is falling, pressure on your money is easing. Second question, is the CPI higher than expected or lower than expected? This is very important because the market does not react to the number itself. It reacts to the expectation. If CPI is higher than expected, that means prices are rising faster than planned, and markets usually panic. If CPI is lower than expected, that means inflation is cooling down and markets usually celebrate. Third question, what will the Federal Reserve do next because of this? Will they raise rates, pause, or cut? That's it. 3 questions. Simple, clear, and powerful. A simple real-life inflation example. Let's understand inflation with a simple, real-life example. Imagine your salary is $1,000 per month. Last year, a bag of rice cost $40. This year, that same bag of rice now costs $60. Your salary did not change. You still earn the same $1,000. But the price of rice went up. That means you didn't get poorer. Prices got richer. Now imagine this happening not just with rice, but with rent, gas, electricity, and food. Little by little, your money buys less and less. This is what inflation really is. It doesn't take money from your pocket. It silently takes value from your money. And that is why inflation is so powerful. The Federal Reserve. The Federal Reserve, also called the Fed, is the most powerful financial institution in the United States. Even if you've never heard of it before, the Fed affects your money, your job, your loans, and your future. The Fed controls 4 big things in the economy: interest rates, money flow, lending, and economic speed. Think of the Fed as the brake and the accelerator of the economy. When the economy is moving too fast and prices are rising, the Fed steps on the brake by raising interest rates. This makes borrowing more expensive, people spend less, and inflation slowly comes down. When the economy is weak and people are losing jobs, the Fed steps on the accelerator by lowering interest rates. This makes borrowing cheaper, businesses invest more, and hiring increases. The Fed's main job is very simple: to keep inflation under control and to protect jobs. They are not trying to make the stock market happy. They are trying to keep the economy stable. That's why every time the Fed speaks, the stock market moves, banks change their rates, the dollar rises or falls, and even housing prices react. One small change in Fed policy can affect millions of people at the same time. So if you remember only one thing about the Fed, remember this: the Fed controls how expensive money is and how fast the entire economy moves. The Fed has only two main goals, just two. Number one, keep inflation under control. Number two, keep people employed. That's it. Everything the Fed does is based on these two goals. Goal 1. Keep inflation under control. When inflation is too high, it means prices are rising too fast. Food costs more, rent costs more, gas costs more, and your money buys less. When this happens, the Fed steps in to slow the economy down. They do this by raising interest rates. Higher interest rates mean loans become more expensive. Credit card payments increase. Businesses borrow less. People spend less. Less spending means slower price increases. This helps cool down inflation. So when inflation is too high, the Fed slows the economy. Goal 2. Keep people employed. Now let's flip the situation. When unemployment is too high, it means many people can't find jobs. Businesses stop growing. Income drops. Spending slows down too much. In this case, the Fed does the opposite. They speed up the economy. They lower interest rates. Lower interest rates mean cheaper loans, easier business expansion, more hiring, more spending. This helps create more jobs and boosts economic activity. So when unemployment is too high, the Fed speeds up the economy.
The Fed's simple rule. Always remember this one simple rule, because once you understand this, everything the Federal Reserve does will finally make sense. If inflation is too high, the Fed slows the economy. If unemployment is too high, the Fed speeds up the economy. That is the foundation. That is the entire playbook. Nothing the Fed does is random. Nothing is emotional. Nothing is based on feelings or opinions. Every decision is data-driven. When prices rise too fast, the Fed steps in to protect the purchasing power of your money. When jobs disappear, the Fed steps in to protect the livelihood of workers. They are always watching two signals: prices and jobs. If prices run too hot, they apply the brakes. If jobs slow down too much, they hit the accelerator. Slow or fast, tighten or loosen, cool or stimulate. Every interest rate decision is simply a response to one of these two problems. The Fed is not trying to make investors rich. The Fed is not trying to crash the market. The Fed is trying to balance the economy. Because an economy with high inflation hurts everyone's savings. And an economy with high unemployment destroys families and future growth. So the Fed walks a narrow road between stable prices and strong employment. Too much control and the economy stalls. Too much freedom and inflation explodes. This is why every Fed meeting matters. This is why every CPI report moves markets. And this is why interest rate decisions shake the world in seconds. So when you hear the news say, "The Fed raised rates," or "The Fed cut rates," don't panic. Just ask one simple question: is inflation too high, or is unemployment too high? Because the answer to that question explains everything.
How interest rates affect your life.
Why interest rates matter to you. Interest rates affect everything in your life, whether you notice it or not. They control loans, credit cards, mortgages, business investments, and even job hiring. You may never meet the people who set interest rates, but their decisions decide how expensive your life becomes. If you understand interest rates, you understand why money feels tight sometimes and why opportunities open up at other times.
What interest rates really are. Simple explanation. An interest rate is simply the price you pay for using money. When you borrow money from a bank, they don't lend it to you for free. They charge you extra for the time you use their money. That extra amount is called interest. So if you borrow $1,000 and the interest is high, you will pay back much more than $1,000. If the interest is low, you will pay back only a small extra amount. It's very simple. Low interest means borrowing is cheap. High interest means borrowing is expensive. That's it. But here's the powerful part. When interest rates change at the national level, they don't affect just one person. They affect millions of people at the same time. Home loans change, car loans change, credit card payments change, business borrowing changes, even job opportunities change. So interest rates are not just numbers on the news. They quietly decide how fast money moves, how much people spend, and how strong the entire economy becomes. That is why interest rates have so much power.
What happens when interest rates rise?
When interest rates go up, here's what happens step by step. 1. Loans become expensive. Car loans cost more. Personal loans cost more. Home loans cost much more. People think twice before borrowing. 2. People spend less. Because borrowing is expensive, people stop buying. New cars, new homes, expensive gadgets. They focus only on necessities. 3. Businesses slow down. Businesses rely on loans to expand, buy equipment, open new branches. When loans are expensive, businesses pause growth. 4. Hiring slows. Since businesses slow down, they hire fewer workers. Some even lay off employees. Job opportunities become harder to find. 5. The stock market usually drops. When spending falls, profits drop, expansion slows, investors become nervous, stock prices often fall. Who benefits when rates are high? High interest rates are good for people with savings in banks, bond investors, people who hold cash, because their money now earns more interest. Who suffers when rates are high? High interest rates are bad for borrowers, home buyers, businesses, stock market investors. Money becomes expensive to use. Part 3. What happens when interest rates fall? Now let's flip the situation. When interest rates go down, the entire economy changes direction. 1. Loans become cheap. Car loans become affordable. Home loans become attractive. Business loans become tempting. People are more confident to borrow. 2. Spending increases. When borrowing is cheap, people start spending again, buying homes, upgrading cars, starting businesses. Money begins to flow through the economy. 3. Businesses expand. With cheap loans, businesses open new stores, buy new machines, expand production. Growth returns. 4. Jobs increase. As businesses expand, they need more workers. Hiring increases, income rises, confidence returns. 5. The stock market often rises. With more spending and growing profits, investors become optimistic. Stock prices rise. Markets rally. Low rates usually mean good times for markets. Who benefits when rates are low? Low interest rates are good for investors, home buyers, business owners, entrepreneurs, because money is easy to access. Who loses when rates are low? Low interest rates are bad for savers, retirees living on interest income, people who rely on bank savings, because their money earns less interest. Part 4. How interest rates affect your daily life. Interest rates don't just affect Wall Street. They affect your monthly payments, your credit card debt, your ability to buy a home, your job security, your investment growth. When rates rise, life becomes tighter. When rates fall, life becomes easier. Even if you never invest, you are still affected. Part 5. Simple real-life housing example. Let's make this very real and very simple. You want to buy a house. At 3% interest, your monthly payment is small and manageable. At 8% interest, that same house now costs you almost double every month. Same house, same buyer, same loan amount. Only one thing changed: the interest rate. And suddenly, one version is affordable. The other version is almost impossible. This is the true power of interest rates. They don't change the price of the house, they change your ability to afford it. Final summary: the big picture. Here is the full picture in simple terms. When interest rates rise, loans are expensive, spending falls, businesses slow, hiring cools, stock market struggles, savers benefit. When interest rates fall, loans are cheap, spending increases, businesses grow, jobs increase, market rises, investors benefit. Interest rates act like a brake when the economy is too hot, an accelerator when the economy is too slow, and every person feels the effect. Strong final takeaway. Interest rates are not just numbers on the news. They decide how much you pay, how much you save, how fast you grow, and how safe your job is. If you understand interest rates, you understand how money actually moves in the real world. And once you understand that, you stop reacting in fear, and you start making smarter financial decisions.
How to follow U.S. economic news beginner system. Simple weekly tracking system. You don't need to watch the news all day. You don't need to stare at charts for hours, and you definitely don't need to be an economist to understand what's happening. If you want to stay informed without feeling overwhelmed, all you need is this simple 3-step weekly system. This system filters the noise and shows you only what actually matters. Step 1. Check CPI once a month. First, check CPI only once a month. That's it. No daily checking, no stress. When you see the CPI report, ask just 2 simple questions. Number 1, is inflation rising or falling? Number 2, is it higher than expected or lower than expected? These 2 answers already tell you a lot. If inflation is rising and higher than expected, the Fed will likely stay aggressive. If inflation is falling and lower than expected, the Fed may start easing. You don't need to read long articles. Just get these 2 answers and move on. Step 2. Watch the Fed meetings. Only 8 times a year. The Federal Reserve meets only 8 times a year. You do not need to watch every speech, interview, or rumor. During every Fed meeting, look for only one thing. What did they do to interest rates? There are only 3 possible outcomes. They hiked rates, they paused rates, they cut rates. Ignore the fancy words. Ignore the long explanations. Ignore the predictions. Just remember the action. Hike, pause, or cut. That single decision tells you whether the economy is being slowed down, kept steady, or sped up. Nothing else matters for beginners. Step 3. Observe market trend, not daily noise. Now let's talk about the market. Do not react to daily moves. Do not panic because the market is red today. Do not celebrate just because it's green tomorrow. Instead, ask only one simple trend question. Is the market making higher highs or lower lows?
If the market is making higher highs, the long-term trend is healthy. If the market is making lower lows, the long-term trend is weak. That's it. Daily noise is emotion. Trends are direction. Professionals follow trends. Beginners react to noise.
If you want more simple explanations like this about money, investing, and real financial freedom, like this video, subscribe to the channel, and comment below if you want weekly market breakdowns. Your education is your greatest investment. I'll see you in the next one.